Welcome back to another episode of Financial Friday here at RE/MAX Property Group. My name is Peyton, and if you thought the housing market's been interesting over the course of the past year, today we're going to take a look into a proposed catalyst that could change things up. We're going to go ahead and kick off looking at a Houston market snapshot and then move into a national policy update. All right, starting off here with new listings up 37% over 2020. As you can see, just in the past few weeks, we've actually jumped above what the average was last year. Come down here to pending listings, we do have up 70% from last year, as obviously that's comparing it to a dip right here in 2020, but sitting with a lot more houses under contract for that. Off-market listings, so these are houses that were originally active and then pulled off, sitting negative 31%, so that's a good thing to see. Less houses, more of them are actually getting closed on rather than becoming inactive. Going down here to closings, so up 52% showings. This is what gets interesting here. We can see we've actually reached in the past all of 2020 and then all of this current year, we've reached a new peak in terms of showing up 137%. Before we dive into the explanation of this proposal, we'll take a look back and kind of see where this stems from. It all started on a cold, dark March 15th when the Fed drops the interest rate to 0%. In efforts to stop the decline from COVID. Okay, but in all seriousness, with the Fed dropping the interest rates down to 0%, they did that in precaution of worried about people losing their jobs, consumer spending slowing down, loans not being paid or going into default, banks stopped lending people money, and essentially just the entire financial system coming to a collapse. So they dropped interest rates to increase cash flow and borrowing just to keep the economy afloat. Following that, on March 27th, we saw the introduction of the CARES Act. This gave a one-year forbearance period to any homeowners, as well as went ahead and put a pause on evictions and foreclosures. So cumulatively, this increased cash flow going on throughout the market made debt extremely affordable. This led to an increase in basically any investment you were looking at. Stock market indexes have been hitting record highs almost every single month. As well as in the past 5 months, investors have thrown more money into the market than in the past 12 years combined. Even during what's often thought of as a market turndown during this COVID period, we see luxury items such as Lamborghini reaching record high production to meet demand as people just try and spend their cash. And of course, real estate being one of the biggest winners of these. With buyers being able to get qualified on a larger loan at lower payments, this in turn helps push up prices. Now, ordinarily, you would think that this can only last for so long before prices start to drop and the market stabilizes. But with now over a year of government intervention in the market, and now this new proposal on forbearances, we could potentially look into prices continuing to increase into the future. One of the main concerns of the housing market right now, stated in headlines, is the fact that 2.5 million households are in forbearance, which means that they basically are putting their mortgage on a pause and not having to pay that due to their economic situation through COVID. One of the main concerns that a lot of people have is a massive wave of forbearance and evictions all hitting the market at once whenever the CARES Act forbearance period ends. This is what this new proposal from the Consumer Finance Protection Bureau looks at. Now, this is just a proposal right now. This gets decided on May 10th, and if this does go into effect, this will hit in August 31st of 2021. So getting in this, we're going to go ahead and break this whole entire thing down. We're going to see what is going on, why this is happening, what could potentially come from this, and then at the end I'm going to give my thoughts just a little bit on it. One of the main things for this bill is this can only actually be used on primary residence. So you're not going to see this accessible to any investment properties or second homes. The availability of this proposal would be fit to anyone who had financial hardships due to COVID, and this would be viewed under the same exact listing as what was in the CARES Act, which is an extremely loose definition and actually kind of gets just left up to the homeowner themselves. Now, anyone that uses this proposal and claims financial hardship from COVID, their lender would actually be required to offer them what's called loss mitigation, in which case the lender would have to go through all possible options with the borrower to see what they can do to have them stay and be able to keep their home. This could be done through loan modification, potential extensions on payments, or an entire new payment plan worked out between the borrower and lender. Now, this is where things start to get a little bit interesting in this proposal. This would offer access for borrowers to be able to go ahead and extend their loan term by modification all the way up to 480 months. Now, as crazy as that already sounds, this would be done without increasing the borrower's periodic principal or interest payments. Now, just to highlight how crazy that's actually going to be, we're going to take a look right now at a $250,000 loan sitting right here at 15 years at 3.5% interest. Periodic payment going to be $1,787. Now, if we take a look at that same $250,000 loan at 3.5%, now extended all the way up to a 40-year loan, looking at a $968 payment. It's almost sitting right about half. So this proposal would offer that extreme of a change in payments while not increasing any interest rates and waiving all fees in terms of loan modification. So this creates as thorough of a pause as they could have written. So you really have a free loan during your forbearance period. Then as soon as you start paying that, any of your late fees or payment fees are going to be waived, and then you can extend that loan all the way up to 40 years. In addition, this would go ahead and extend the block period on foreclosures. So that would give you a runway all the way until the end of 2021 for them to actually be able to file for that. So one of the biggest issues I see with this is all deemed through the personal classification of financial hardship from COVID. There is no bracketing or diversification between that, so anyone could claim that, whether it's they didn't have a job from COVID all last year, or it could be someone making $500,000, but that might be a 30% decrease from year prior. Once again, this is just a proposal as of right now, open to public comment until May 10th. But of course, if this goes through, this could be a huge change for buyers and sellers as it completely changes the financing of the market. So over the past few months, we've been witnessing the 10 and 30-year Treasury bond yield increasing as people's concerns heighten over inflation, which is starting to drive up the mortgage interest rates. So a more expensive mortgage means that a buyer can afford less house, which should start to bring down the housing prices. Well, no, that's not happening at all. Prices are still rising for two main reasons. One, we're still sitting at record low inventory numbers. And two, more buyers are trying to get into the market now before interest rates continue to rise. For reference, back in March of 2017, we had almost 1.3 million active listings across the country. But sitting today, there are less than 500,000. This forces all the buyers to compete with whatever's still left on the market in a low inventory, which in turn drives prices even higher. From a numbers standpoint though, things actually are starting to look better. While yes, it's scary to see that 2.5 million homes are still under forbearance, we actually have been seeing a steady decrease over the past 9 months. Finally hitting now under 5% of all mortgaged homes being on forbearance, we can see that more people are getting back on their feet and able to make payments, or they just took it as a precaution to begin with because they didn't know where things were headed. However, with all the excess demand in the market, it ended up pushing up the average homeowner equity $26,000 in the fourth quarter of 2020. This means that if you owned a home in 2020, you probably had a pretty good increase on equity. This also means that the likelihood of a home actually going under foreclosure today is fairly low. This is because generally, only homes without any equity are going to go into foreclosure. Otherwise, it'd be much more beneficial for the homeowner to just go ahead and sell their property, take the profit of their equity, and just move on. When diving back into the numbers on this, it's shown that only 2.8% of all mortgaged homes have negative equity or are considered underwater on their loan. This means that the homeowner owes more on the property than what it's worth. So while you have 2.5 million homeowners in forbearance, you have less than 3% at actual risk of foreclosure. When it comes to my own thoughts on this, in terms of is this sustainable, especially with a 40-year mortgage, here's what I think. Just going off the numbers, I don't think that there's going to be this mass foreclosure crisis. If we're taking a look and comparing it back to something like the 2008 housing market crash, we were constantly seeing adjustable rate mortgages with zero down, putting them at instant risk of foreclosure. With only under 3% right now holding a negative equity on their house, we can compare that back to 2008, where 1 in 4 homes were sitting at negative equity. In a position where we still have low fixed interest rates, banks are only lending to the most qualified of buyers, and if a seller can't afford to make their payments, they could go ahead and sell in this market and still make a good profit. I just don't see that many foreclosures coming along. Now the risk is, if interest rates suddenly jump up and everyone decides to list their house at once, we could see a substantial drop in prices. Now from what we've seen, most homeowners don't want to involuntarily sell their home. So if they can't make payments or they've gotten behind, odds are they're going to work out a payment plan and try and stay in that home. For interest rates, I would plan on those going ahead and continue to increase over the next few years, but very gradually as it gives time for the market to adjust. Now, one of the problems is that we've artificially created a lack of inventory by stopping the sale and foreclosure of homes through policies that inadvertently start to raise housing prices. Here we're going to take a look at my extremely proud and professional artwork creation of the market. If housing is like a river, we always have a constant flow of people wanting to sell their home for various reasons. But as we alter the market by offering forbearances, stopping foreclosure, and giving 40-year mortgages, we end up damming off the river and stopping the flow of supply. So now after these changes, you still have the same number of buyers in your pool, but now you have half the inventory coming in, which is going to drive up the price. And now you sprinkle in the little magic dust of low interest rates given by the Fed, and you increase your buyer pool even more while still keeping the low inventory. And now we have the housing market today. Now, one of the thought processes is just to let the market function as is, and if people can no longer afford the payment on their house, just go ahead and let them sell it for a 10 to 20% increase as they've gained that equity in the past year. The counter argument for this being that too many homes would come onto the market for sale at once, throwing a massive backlog of the inventory into a market that's just not ready to handle this. This creates the worry that prices would come down too fast and disrupt the market. And the goal here is to not force homeowners out of their home if they were negatively impacted by COVID. There definitely is no easy answer to any of this, and as much as I would like to say just change the zoning requirements and build more homes, there is no telling of how much that would cost as well and the influence it would have on the market. It's still early to tell exactly what's going to happen with this proposal, but I have a feeling the chances of a mortgage servicer extending all the way out to 40 years is highly unlikely. Now, I do see banks and mortgage lenders extending loans out 5, 10, or 15 years to be able to help lower monthly payments. I think the best thing to do is just keep a close eye out on the market as well as this proposal, as this could change a lot of things, but it's still in public remark until May 10th. Be prepared to buckle yourself in for a whole nother year of housing news, but at least have the peace of mind that housing isn't going anywhere and it is still one of the most resilient long-term investments you can have. Thank you so much for tuning in to another Financial Friday here at RE/MAX Property Group. Once again, we'll be running every single Friday, doing a short market update and then covering a trending topic that might influence your home ownership. To stay connected outside of just the weekly videos, feel free to follow my social media here on Instagram and Facebook. And don't forget to tune in next Friday here at RE/MAX Property Group for another update and see what you need to know in the market.